Italian Debt Default by www.theforexnittygritty.com. Is worry about Italian debt default next on the Forex agenda? As the Greek debt crisis lingers, it is like an infectious disease that is spreading across the Eurozone. The so-called PIIGS debt crisis has plagued the European community and repeatedly driven the euro lower. As talks about debt relief for Portugal and especially Greece drag on, the Forex markets are worried. If the EU does not respond decisively in the Greek and Portuguese situations, an Italian debt default is a possibility. Debt of these nations is held by a variety of investors, some private and some governmental. The Japanese are regular investors in euro-dominated and US dollar-dominated debt. This is because Japanese interest rates have been at near zero for 2 decades. Japanese investors practice a carry trade in yen. They take savings that could have been invested in Japan and move them overseas to the USA or Europe by purchasing dollars or euros. Then they invest. For example, they buy government bonds which pay an attractive rate of interest. However, when these bonds come due, investors worry that the Italian government, in this case, or the Greek government, will not pay back their principal. This adds an Italian debt default to a Greek default on the investors' list of worries. The euro stands near an all-time low against the Swiss franc and has fallen versus the dollar as fears of a spreading debt crisis engulf the currency markets. With this crisis as a backdrop, members of the European Commission, the European Central Bank, and the European Council are meeting. The problem for the ministers is that the longer they take to come up with a solution to the crisis in Greece, the more time traders have to worry about the debt crisis spreading. Then traders who are worried about an Italian debt default exit their positions in euros, further driving down the continental currency. The burden on the European central banks includes the increasing financing costs associated with increasingly less attractive debt. Those Forex trading the euro will take the actions and pronouncements of these central banks seriously in choosing their euro trades. Many foreign investors, such as the Japanese, are currently selling their Italian bonds and converting the proceeds out of euros into yen, dollars, or Swiss francs. Whether they see the dollar as a safe haven currency in this situation or simply want more reliable investments in the USA, the net result is to drive down the price of the euro. One factor preventing a free fall of the euro versus the greenback is the ongoing catfight between the U.S. Congress and the administration regarding U.S. sovereign debt. If the U.S. does not increase its debt ceiling, Forex traders will be worried about a default that would make Italian debt default look tiny in comparison. If the parties involved in U.S. talks simply agree to increase the debt ceiling again, they will reassure Forex investors in the short term. However, no one is fooled into thinking that the U.S. can continue to heap debt upon debt and not reap the consequences in a steady slide of the U.S. dollar versus all of the currencies of the world. For more insights and useful information regarding the Forex markets and foreign currency trading, visit www.theforexnittygritty.com.